Hey everyone, Brandon Lewis here, your local mortgage lender here in Richmond, Virginia since 2002. Here with another edition of Mortgage Help Us Here, and today we are talking about the mortgage pre-approval process for the self-employed borrower. So if you're self-employed looking to buy a house, this one's for you. Stick around. Now, why do these tips matter for the self-employed borrower compared to a W-2 borrower? It's all about calculating the income. In order to calculate the income for a W-2 wage earner, it can be very simple. You take their annual base divided by 12, there's your qualifying income. If they're an hourly employee, then we're going to multiply the hours by the hourly rate and determine what their qualifying income is there. So it's pretty straightforward and simple on a W-2 wage earner. But for you self-employed folks, it's a little bit different. You get the benefit of writing off tax deductions, depreciation, carryovers. There's a lot of strategic moves when filing your taxes that may show a lower number on paper than what you've truly earned in income throughout the year. And that's what we're going to talk about today, is scenarios where we can and can't use that net and gross income and making that pre-approval process as easy as possible for you. All right. So why do self-employed borrowers face more scrutiny than the standard borrower? We just talked about income. That's one answer. So what are the underwriters looking at when it comes to your income? The primary focus is on the income, and they want to see that it's stable or increasing. If you have a decreasing business or decreasing income in your business, then obviously that's going to be a big red flag for the underwriter. Not that it's a deal killer, but it could be a big red flag for the underwriter, and we'll jump into that in a little bit more. So consistent income or increasing income is what they want to see. So this can be a challenge sometimes for your seasonal businesses. What about that ice cream shop that only sells, higher sales in the summertime than they do in the wintertime? Your jet ski rental places at the resorts, your holiday decorating businesses. These are all seasonal businesses where their income will vary from month to month or from season to season. So again, not that these are necessarily deal killers, but we want to prepare in advance to be able to explain those dips in income to the underwriter and paint a strong picture for the business's outcome. All right, another reason it's so complex for the self-employed home buyer. Again, the W-2 employee, we just get the W-2s in, pay stubs, pretty straightforward and simple, right? All right, for you self-employed folks, I've got to get either Schedule C's, your 1120S's, corporate returns, K-1s, 1099s, you name it. There's all types of documents out there that I can get from a self-employed borrower in order to qualify you based on the income the traditional way. So again, this takes a little bit more time to prepare, and that's why the pre-approval process for the self-employed borrower takes just a little bit longer there. So keep your documents in a neat and orderly fashion. This will help when you go to that mortgage pre-approval process. All right, what are some advanced tax strategies that can actually hurt you in the mortgage pre-approval process? The most common and one that we see all the time is just excessive write-off. Let's say you're a sole proprietor. You have a Schedule C that you file your income on in your tax returns. You had $100,000 in gross receipts and income coming in for the business, but then you wrote off $80,000 in marketing, travel, types of other expenses that you had. Well, at the end of the day, we only have $20,000 in income to show to the underwriter. So excessive write-offs can absolutely hurt you in that area. We want to plan ahead of time, especially if you haven't filed your taxes just yet. So with all the ways that a self-employed home buyer could take deductions on their taxes or reduce their tax liability on paper, it just means more time to prepare and explain that to the underwriter. So again, we need all the documents in, thorough review, get a list of questions together that we think the underwriter is going to ask. And then we'll start addressing items one by one and start to paint together the picture of a strong business. All right, delayed financing or extension. So if you are behind on filing your taxes, that's definitely a setback there. Some lenders will allow you to proceed forward with an audited CPA prepared P&L statement or profit and loss statement. But again, that costs thousands of dollars there, and it's far cheaper just to file your taxes. Stay on top of your taxes, keep clean paper records of everything. And again, that'll make it a lot easier when you're providing all the documents that we're requesting, and a lot quicker. Now, keep in mind, if you own multiple entities, multiple businesses on your tax return, 30% of this LLC, 20% of this S corporation, and we've got a little C corp ownership in there as well. It's going to take a little time to break down all that different income and factor in which amounts you are able to use as qualifying income. The more complex the situation, the more time it's going to take to get this loan pre-approved. All right, understanding why the pre-approval process matters for our self-employed borrowers. and why it is so important. Mainly is proactive planning. Again, there could be different tax strategies you may take on your tax filings to reduce that tax liability. But again, that could have a negative impact on your mortgage qualification. It is not uncommon that I get to know your accountant. We get a nice introduction and we get to talk about what the underwriter is looking for versus what you're looking to accomplish with your accountant in filing your taxes. And we can generally find a happy medium there that'll get you a little best of both worlds. All right, time sensitivity and competitive market. It's a crazy market out there right now, even with the high interest rates. So you want to make sure you have a strong pre-approval letter. That pre-approval letter does not mean anything if the lender has not done their due diligence in pre-approving you for that loan. So a lot of paperwork, a lot of questions. It takes a couple days to put together a rock solid pre-approval letter for a self-employed borrower. All right, the other one is the risk of last minute surprises. Last thing you want to do is roll up into an open house on the weekend there as a self-employed buyer, not talk to a mortgage lender at all, fall in love with the home, want to make an offer on it, and then you have that conversation with the mortgage lender and you come to find out due to tax strategies or whatever it may be, declining income, things like that on a tax return, that we're not able to get you qualified for that dollar amount of that particular home. That's the key thing as well. Let's make sure that we can put together a mortgage in line with your goals. So I've talked a little bit about the excessive paperwork needed for self-employed borrowers. So let's just dive into that in a little bit more detail. So when looking at your list of documents, and this applies in a couple different areas in the mortgage world, but we just call it the rule of two. When a lender is asking for your documents, they're going to want a 2-year history of your tax returns, 2-month history of your bank statements, 2-month history of your pay stub. When coming to the application, we're looking at a 2-year history of your residential information. We're looking at a 2-year history on your employment information. Same line of work, same pay structure, whatever it may be. But again, it's just a general rule of twos that we follow in the mortgage business. All right, so keep in mind the underwriter is going to take a look at your 2-year history just to see the stability in income and hopefully increasing income as well, but overall health of the business. Now, when we have our discovery call and we go over basically what your home buying goals are, your current situation, I'm going to have some questions as the mortgage lender, but from there, we'll start to put together a list of documents that we need from you. So again, as a self-employed borrower, you may have a Schedule C. You may be an S corporation and pay yourself with actual pay stubs and W-2s, even though you're self-employed. You could be a C corporation, and file it based on the K-1. So a lot of different ways that we can calculate the income there, depending on what type of business structure you did when you set your business up. Now, another good thing about getting all the tax returns in advance is it allows us to look for things like depreciating expenses. In some cases, those could be rolled back into your qualifying income. Taxes aren't always bad for us. Sometimes we can squeeze a little bit of those expenses back into the qualifying income. But again, it takes a little time to review the documents, get all that knocked out. Now, when we ask for that 2-year history, here are some of the things that we're going to ask for as a self-employed borrower. So again, 2-year personal tax returns, 2 years business returns, 2-year corporate returns. The point is, for self-employed folks, it's just a lot of documentation that y'all could have to provide, but different to everybody's unique situation. So again, sole proprietor is going to send me one thing, somebody with multiple ownerships in partnerships, LLCs, corporations, whatever it might be, they're going to send me a whole lot more information. After the discovery call, where we get to know what the details of your business are, we can then put together a custom list of documents that we would need from you. Make sure your profit and loss statement's always up to date. We're going to ask for the previous two calendar year tax returns, but we want a little snapshot of what's going on this year as well. So make sure your profit and loss statement's kept up to date, either by your bookkeeping systems, Quickens, whatever it may be, or your accountant. And again, remember this is always the theme with self-employed borrowers: stable or increasing income. That's what they want to see. So that P&L needs to support what we see in those previous 2 years tax returns. Again, just to support that same theme and trend that we're seeing, which stable or increasing. And I could go on a list of different documents. You've got your 1099s, your K-1s. It's just a plethora of different documents that apply to the self-employed borrower. So again, once we have that conversation, we'll put together a detailed list for you so you know exactly what we need to put together that solid pre-approval. Income calculations and what underwriters are looking. So you've heard me say several times already, stable or increasing, right? That always needs to be the theme with the income there. Now, It doesn't mean that a dip in business is going to kill your opportunity to buy a home. We just may need to explain it, do a little research in advance, and figure out what's the best way to explain this to the underwriter. Declining income or dips in income are definitely going to have to be explained to the underwriter, as those are going to be red flags. Here's how we mitigate those concerns with the underwriter. And again, this depends on how severe of an income drop that we have. Is it even explainable? But generally, this is what the game plan would be. Be prepared to explain the dip in income. We need to go into great detail to explain why the income has dropped from its, say, same time last year or whatever it may be, or why is the current 6 months 20% less than the previous 6 months income. This is the way that the underwriter is going to break it down. So we need to be prepared to explain for those dips and fluctuations in the income. And again, the way we do that is just a quick phone call, discuss what exactly the underwriter's concern is, and see what exactly happened. What caused that dip? Was there extenuating circumstances outside your control? And then we can go forward from there and present that to the underwriter. So what the underwriter is looking for in the income is pretty straightforward and simple, right? They want to see stable and increasing. My recommendation to all self-employed borrowers is begin the process at least 6 months out from the time you want to close on your home. You need a lot of time to prepare. There may be some changes that need to be made. But again, it's putting a strategy in place to set you up for the most successful home buying experience possible. So again, 6 months, 3 months at the worst, but don't just jump in there on the weekend and think, hey, I'm a complex situation, I'm going to get this qualified over. Not always that easy. Sometimes we need to run things by the underwriter just to make sure we're going to issue that solid pre-approval letter. Now, here are a few common pitfalls to avoid. These will always create problems in the underwriting process and so easy to avoid, especially if you're preparing in advance. The most common one I see is mixing business and personal expenses, right? So let's say you have a vehicle that's a company expense, right? Well, then the company needs to pay for that vehicle loan. The underwriter is going to make sure that the underwriter sees those payments coming out of a business account going directly to the creditor. If we now see those payments coming out of your personal account and going directly to the creditor, well, that may be considered a personal expense there. So again, more important to start things in advance, and let's make sure that we're doing everything by the book. All right. Again, the other one we see all the time is just overriding expenses. Tons of expenses being written off, and it just whittles that qualifying income down. So talk to us first. Let me show you how those tax write-offs will impact your qualifying income on the mortgage side. All right, so remember this. Always use separate accounts for your personal and business accounts, expenses, everything. Bank accounts, car loans, whatever it might be. If it's a business expense, title it as a business expense. Pay it from the business accounts. If it's personal, pay it solely from your personal accounts, not the business accounts. This will make things very clear to the underwriter on how to calculate your debt to income ratio. Just as you want to start the mortgage pre-approval process early, you want to start even earlier with your tax preparer. So meet with your CPA when you think it's a year or 2 years out of buying that home. Let them know what your goals are so they know how to structure your taxes to set you up for success there. That's a huge tip because that could take a lot of concern out, and your accountant may be able to introduce you to a good qualified mortgage lender that's familiar with self-employed income and the different ways it can be interpreted. All right, let's talk about a few tips to increase your chance of loan pre-approval and getting your offer accepted. First and foremost, work with a self-employed savvy mortgage lender like myself. If a lender's not familiar with tax returns, how to calculate that income, it can be very intimidating. Some lenders prefer to stay away from that altogether. But again, working with somebody that specializes in that field saves you a lot of headaches during that process. Not all lenders are created equally. So some lenders may be more your traditional lender, going by the Fannie Mae, Freddie Mac conventional qualified mortgage rules. And then you may have other lenders that have a little bit more flexibility and be able to play in the non-QM space. For the self-employed borrower, that's a huge difference because one means we're only using net income, which we know is the figure on your tax return, which is lower than the real number, versus your cash flow of the actual business, which is always going to be healthier than the tax return. So that's going to be the other big difference, is whether or not a lender will allow you to use your net or your gross income as a self-employed borrower. Two very different numbers that can provide you two very different pre-approvals. Another tip is you always want to maintain the best credit score possible. Just one less thing for the underwriter to give you a hard time about. So keep it above that 700. you'll be in good shape. Now, as I see with most self-employed borrowers, they do keep their monthly expenses fairly low because income can be inconsistent, especially in the early years. So it's important to keep your debts low. We want to make sure your debt-to-income ratio is low as possible, showing that you're not overextended or too much income going to one area. All right, one more. Plan your tax filing strategically. Coordinate closely with your lender and your CPA. Again, it's not uncommon that we get to know your CPA and talk to them on a regular basis throughout the process to make sure your tax returns reflect the picture that the underwriter needs to see. All right, again, another big one is maintain separate accounts. Don't intermingle business and personal expenses at all. Keep everything very separate. Business expenses, personal expenses. Do not intermingle. I just mentioned a second ago that some lenders may allow you to use your net income or your gross income, right? And obviously in a self-employed situation, you want to use your gross income. That's going to be the higher figure. That's going to show you a stronger qualification to the underwriter. So for example, I had one recently come to me, self-employed borrower. He came, he was approved for up to $360,000, was trying to get into the $500,000 range. Once we flipped him over to a program that allowed me to use his gross income based more off his cash flow, we were able to get this gentleman approved for up to $600,000 if he wanted to spend that amount. So again, we're talking huge difference on what you will qualify for based on using your net income versus your gross income. Now, when a lender uses your gross income, there's a couple different ways to calculate that income. So again, we may take it off your past 12 or 24 months bank statements, and that could be your personal or your business bank statements there. May use 1099s, average out your 1099s over a past couple year period. There are several other programs for a self-employed borrower, but it all depends on which one's right for you. So when we meet, we discuss your goals, we lay out every mortgage option that's available for you and determine through process of elimination which program is best. I don't want to bore you all to death with a million different mortgage details. We'll do that on a one-on-one basis for your particular situation. I do want to mention one cool one though that we have real quick. The DSCR loan, debt service coverage ratio loan, great investor loan, 20% down, standard as you would on a conventional product. But instead of using your personal income to qualify for the loan, we're going to use the income that the property generates. That's right. Just looking for a 1-to-1 ratio on that. I'll give you more on that a little bit later. All right, let's wrap it up just with some key takeaways and some important points that I want y'all to carry away from this that will make a big impact on your mortgage pre-approval process, right? All right, so number one, early planning. Reach out to that mortgage lender, 6 months out from wanting to buy the home. Let them review all your financial documents. Figure out which product will be the best way to go for you. Are we going to be able to use traditional income and be just fine? Or are we going to need to go with a non-qualified mortgage route and use gross income? One's not better than the other. Both offer competitive interest rates and great programs all around. Now, when the lender does ask for documents, let's say, for example, your bank statements, you can now link your bank statements with the lender themselves and they can pull the statements. If you don't want to do that and you still want to just email us PDFs, please make sure you include all pages on that. So we need to make sure page 4 of 4 is received, even if it states that it was intentionally left blank. So just a little tidbit there that'll save you some frustration and headaches as we go through the process. Choosing to work with a self-employed savvy mortgage professional. Again, it's very important to work with somebody that understands the complexities of the business income, the debts, deductions, depreciations, carryovers, and be able to present that to the underwriter clearly. All right, folks, this has been Brandon here in Richmond, your local mortgage lender specialized in self-employed borrowers since 2002. If you like the information you saw today, hit that like button for me and subscribe, and I'll see you next time.